Good morning, everyone, and welcome to another edition of Moneyline with Nancy. I am Nancy Najib. This morning, earnings are in focus, and all eyes are still on the banking sector. From recapitalization to resilience, Nigeria's banks are stepping into a new era. The central bank has now confirmed that the recapitalization process, of course, is completed, a critical milestone that signals stronger balance sheets, deeper shock absorption capacity, and a banking system positioned for scale. But here is the big question. What does performance look like from here? Because completing recapitalization is one thing, delivering sustainable returns in a high inflation, high interest rate environment is another. And so we move into, and as we move definitely into full year seasons, earnings season, 2025, we're going to be expecting earnings from listed companies on the exchange. The market is watching very closely, and not just for profits, but for quality of earnings, risk management, discipline, and capital efficiency. We will begin, as we continue to watch those earnings, we'll begin with Zenith Bank PLC, which I just released its 2025 full-year result. I saw that on the NGX website also, and the numbers are quite revealing. If we can take those numbers, gross earnings crossed 4 trillion naira, interest income surged by 35%, and net interest income jumped by over 50%. But scratch beneath the surface, profit before tax declined, earnings per share fell, and total comprehensive income took a hit, largely due to foreign exchange losses and fair value adjustments. At the same time, the bank cleaned up its books, writing off forbearance-related exposures, improving its non-performing loan ratio, and maintaining strong capital and liquidity positions. So is this a story of strength or a story of transition? Because what we are seeing is a bank and perhaps a sector repricing risk, rebuilding quality, and preparing for a different kind of growth cycle. There is more. Nigeria has just been reclassified by FTSE Russell back to the frontier markets, a move that would unlock fresh foreign capital inflows and reposition our equity markets on the global stage. The Nigerian exchange has already gained over 29% this year, but foreign participation remains thin. Can we actually also take that second graphic so that we take a look at the FTSE Russell? Like I mentioned earlier on, foreign participation still remains thin on the Nigerian exchange. So the question is, will stronger banks' balance sheets and improved market structure translate into sustained investors' confidence? So you can just see it on the screen, from unclassified to frontier. Increased foreign capital inflows, I mentioned earlier on, 29% market gains so far this year. That's overall. The YTD, that is the year-to-date performance, year-to-date returns of the Nigerian Stock Exchange, or Nigerian Exchange, stands at over 29%. Joining me to break this all down is Ugodre Obichukwu, who is the founder and CEO of Nairametrics. He'll be joining me shortly to take a look at this and more. But even as Nigeria's banking sector signals strength and resilience, a deeper, more urgent reality is emerging, one that goes beyond balance sheets and into the future of our nation. At the launch of the April 2026 Nigeria Development Update by the World Bank, which was anchored by me, and of course I moderated the session, a sobering statistic stood out, which is 110 out of every 1,000 Nigerian children do not live to see their 5th birthday. I have to say it again, 110 out of every 1,000 do not live to see their fifth-year birthday, their fifth birthday. Yes, macroeconomic reforms are important. Macroeconomic reforms are beginning to show signs of stability, according to the federal government. Inflation is moderating, non-oil revenues are rising. But for many households, the reality is still deep pain. We also have a graphic card for you to be able to understand what we're saying. With high prices continuing to erode purchasing power from surging fuel costs, with petrol up by as much as 50%, to rising food and transport prices, the cost of living crisis is colliding with a human capital emergency. And the message is clear, especially with the launch of the Nigerian Development Update for April 2026. Without investing in early childhood development, Nigeria's economic gains may never translate into real prosperity, because true growth is not measured in profits, but in people. So that's it, really, for what we're following for you at this time in terms of my opening. So much to talk about, but Ugodre Obichukwu will be joining me shortly to take a look at that. But let's take you through the news at this time. We'll begin by telling you that NNPC Limited has exported the first cargo of its newly introduced cotton crude blend to the global market. The shipment, loaded on April 5, 2026, departed from an offshore facility near Bonny, River State, and is headed to the Netherlands. The maiden cargo, estimated at about 950,000 barrels, marks a key step in Nigeria's effort to expand its crude oil export portfolio. The new light sweet crude grade is expected to attract strong demand due to its high petrol and diesel yield. The federal government has announced plans to waive demurrage charges on containers affected by early operational glitches on the National Single Window platform. The decision was revealed during a joint assessment visit to the National Single Window office in Apapa by the Nigeria Revenue Service, Nigeria Customs Service, and the Presidential Enabling Business Environment Council. Chairman of the Nigerian Revenue Service, Zach Adedeji, said the government will work with terminal operators to ease the financial burden on importers during the transition. FTSE Russell has reclassified Nigeria from unclassified to frontier market status effective September 2026. The move, announced through the Nigerian Exchange, comes after improvement in market transparency, infrastructure, and foreign exchange liquidity. This milestone is expected to boost investors' confidence and attract more foreign capital into the Nigerian stock market, which is already up over 29% this year. Nigerian Exchange CEO Temi Bokmola described the reclassification as a major achievement, highlighting ongoing reforms and collaboration among regulators and market operators to position Nigeria as a competitive destination for global investment. Let's talk about cash outside the banking system. It has declined 3.66% to 5.21 trillion naira in February 2026, reflecting the moderation in demand after the year-end festive spending surge. Total currency in circulation remains stable at 5.73 trillion naira. According to the Central Bank of Nigeria, it notes that seasonal pattern is common, and as households and businesses return excess cash after the holidays. Over the past year, cash demand consistently peaked during festive periods and eased in early months, showing the cyclical rhythm of Nigeria's liquidity and informal cash usage. All right, the African Export-Import Bank, that's Afri-Exim, has launched a $10 billion Gulf Crisis Response Program to protect African and Caribbean economies from the impact of the ongoing Gulf conflict. Announced on March 31, 2026, the initiative provides short-term liquidity and foreign exchange to sustain imports of fuel, fertilizers, and food, while supporting energy and mineral exporters to seize new market opportunities. Headquartered in Cairo, Egypt, Afri-Exim says the program will also strengthen long-term economic resilience by boosting infrastructure and productive capacity, helping member countries navigate the crisis and future shocks. All right, that's it for the news at this time, the news in the financial space that we are following. So much to talk about, especially with what's happening around the world now. Our banking sector, the recapitalization, full-year earnings season coming out. So we're going to be seeing it left, right, and center. If you're a bank customer, if you're a shareholder, you should actually also be very interested in what these numbers are and perhaps also what they mean for you. The Central Bank of Nigeria has said the recapitalization is concluded, that 3 banks met the recap requirements. Will banks be doing better? We're seeing earnings come out at the Nigerian exchange. Of course, they are listed there. I'll be talking about the banks and more, perhaps when we come back from the break with my guest, Ugodre Obichukwu, who is the founder and CEO of Nairametrics. We'll be right back.
Previously on Moneyline with Nancy.
Vulnerabilities that the Central Bank of Nigeria was concerned about before this exercise.
Right. When you look at the exposure of a Nigerian banking system to certain sectors and the implication of the developments in those sectors over time, challenging the resilience of our banks, it was a signal for the Central Bank to immediately institute recapitalization. Also, there had been certain reforms that had also impacted on the quality of banks' loan book. That also informed the need to begin to reposition banks to ensure that they are able to address the risk posed by those
This is Moneyline with Nancy, and this is a program that sets your business day for you.
Inflation played a 9-1 on us, and the cost of doing business and the cost of living crisis persists. But we can win. We can win on those 2 things.
We need to work on our infrastructure, maintain what we have, and add new infrastructure. Isn't it interesting to you that it still costs less to ship something from China to Lagos than from Dakar to Nigeria?
Resilience is not only bouncing back when there is crisis or shocks. Resilience is about the ability to adapt, the ability to innovate, the ability to thrive in a VUCA world, which is basically a world that we have a lot of vulnerabilities, a world that we have a lot of uncertainty.
Thank you, Nancy. You've been doing a great job in trying to educate Nigerians, and we must appreciate you for that.
Everybody tells me you're the gold standard in this business, yeah.
More Nancy Naji, for the best you can be, but that change as well.
barbecue. Unwrap joy. Unleash taste.
Ugodrio Bichuku joins me right now. Ugodrio Bichuku is the founder and CEO at Nairametrics. Hello, Ugo. Welcome to the program.
Hey, Nancy. Good morning. Thank you very much. Always a pleasure being on your show.
Yeah, fantastic. It's good to have you. I don't know if we've spoken about recapitalization completion, have we? We haven't. No, we have not.
No, we haven't.
I've not spoken about it with you on the show.
Yes.
Yes. So I think I should start from that. With the recapitalization now completed, what should investors prioritize more? Should it be capital strength or perhaps earnings quality, as we'll be discussing shortly?
I mean, I think they go hand in hand. Very important for us to know clearly how a lot of the banks that raise capital deploy that capital. If we don't know how they deploy the capital, then how do you know who is more efficient? And so for me, yes, they go hand in hand. Now, also mind you, Nancy, this is just the first phase we have completed. The second phase, of course, is the CBN is also saying, bank also needs to have stronger risk management framework. They put out a separate, I think it was last week or so, where they said we continue to stress test, and banks that are still required to shore up their capital will need to shore up their capital as well. So it appears you're also seeing a central bank that is not just on its ours. They're also trying as much as possible not to have us repeat the same mistake we did in the bank capitalization era under Soludo, where we saw a lot of banks deploy a lot of that capital to very risky lending. And so I don't see a repeat of that happening. Rather, I think you have banks that are a lot more resilient, banks that are a lot more competitive, and banks as well that are very keen to grow their top line and bottom line in a very aggressive manner. So that's what I expect. So it's got to be both, not just focusing on one and leaving the other. Earnings is important, and ensuring that you continue to have a very strong capital base is also key to determine what bank wins. Remember, you're also in an environment where there's a lot of competition coming at banks. You have the new banks trying to outcompete banks with technology. You also have foreign banks as well, because banks are also expanding beyond Nigeria, being competitive as well. You have a change in the world order, which means businesses are also rethinking how they operate and how they also bank. So these are all the things banks are facing. And so it's not just enough for them to focus on being recapitalized. How they sweat that money and increase their is also very important.
Okay, Ugo, I did interview the Director of Banking Supervision at the Central Bank of Nigeria, Dr. Lubukola Akinwumi. He was on the program. And I did ask him, especially talking about this recapitalization, I did ask him one question, which is, are we now seeing banks that are too big to save? What do you think? He took a while to answer my question. He took a while, just like you did.
It's really kind of spotted that is so, I like that, very genius.
Exactly. Big, yes, because we haven't thought about it, you know, so I had to ask them that question.
There is no bank that is too big to save. I mean, I mean, in total, the total amount that was raised, just remember, 4.6 trillion. And this is basically close to quite over 3.5 billion. So not that much that we can see. Now, but let's also remember that the central bank now is very keen with monetary policy. So for that reason, I doubt that bank failures at a very large scale will be tolerated, will be allowed to happen. That is why I mentioned earlier that immediately the central bank, knew that a lot of these banks have met their recapitalization. I think 33 or 34 of them. The next thing was that risk-based assessment continues. So stress tests, they need to keep doing, comply with Basel II requirements. Banks that need to show up their capital need to show up their capital. Another thing as well that I hear that they're also doing, they're also trying to work with legal authorities, with the judiciary to also ensure that, banks who lend money to borrowers can also have a part recovery that doesn't end up being a long-term process. This is an entire systemic problem to the economy, not just the banking sector alone. So I don't think we have banks that are too big to save or too big to fail either. I think what needs to keep happening is the strengthening of the system in such a way that risk is better managed. And then you also have a lot more responsible banking, especially at the direct rate level. Single obligor limit is also something that the central bank is very, very keen to win in on. You know how very well that has been abused over the years. In fact, for a lot of people, that's one of the reasons why you have banks that have nearly failed. So these are all the things they're trying to tighten. So, I mean, we're in a market environment, so it's possible to have a bank that might one day not be able to continue. Yes. But I think that the fact that we haven't had this, we've also had bank failures very well managed over the last, 5 years plus. In fact, over the last decade, also shows that I think the central bank has sort of figured out a way to manage this issue. Also, in a way that it doesn't create what we call a moral hazard. A moral hazard is that, because you know that you will always be bailed out at one point or the other, so you want to be safe. They are trying to balance that. Well, we don't want any bank to fail. We're not going to sit down here and allow banks to misbehave in such a way that at some point they need to get built out. So if it means firing an entire board, an entire management, I believe the CBN will do that. So that's our response to a very tricky, serious.
Yes, I had to ask him that. In fact, after the program yesterday, he told me, said, Nancy, I think that was actually a good question that, I gave him something to think about. I said, that is why I cover this bit, and I've been covering it for a long time. So I can actually see the gaps. Yes. So, and also give you guys food for thought at the Central Bank of Nigeria, because what we're seeing now is that we're having bigger banks and all of that. All right. It's earnings season. What do you think, Ugo? Are you encouraged with what you're seeing? Zenith Bank just came up with what? I don't even know what to say anymore. Zenith Bank just came up with earnings. We're still talking about recapitalization. We've not yet recovered from that, and we're seeing this coming in from the bank. What do you actually think? Let me just get your general sentiments about the kinds of earnings we'll be seeing from banks.
Nancy, I love the earnings season. That is really the way people look up to Christmas.
Yes.
The way I look up to earnings season. So I'm so
as
happy
an investor now.
We get to enjoy it 4 times in a year.
Yes.
Every quarter. So And some of the earnings that we've been seeing has been very, very encouraging, particularly from banks. And not just the quality of the earnings, but something that is also very important. I mean, it's a big word, it's a small word to use, but it has a lot of meaning, like the honesty of the earnings. It's very important. And when I mean honesty of the earnings is, you're also seeing banks take the bull by the horns, right? You're saying, okay, you know what? A lot of issues have been had in the past. While we're making super profits, we're very happy to take write-downs, and we're happy to show quality earnings that is backed by cash. I think that's very important, and it's a very important story that maybe we're not telling a lot. And so if you look at some of the earnings that we've seen, that has been what we've seen all through. We've seen banks that have found ways to make money in a very, very difficult economic environment. And if I look at Zenith, on the spotlight here, this is a bank that has taken, and remember, I told you this last time we spoke. We spoke about Zenith. I said, I am looking forward to a very solid full year earnings. It's a bank that are taking 740 billion in impairment charge last year, just so that they can get out of that forbearance issue, which is also one of the things that the central bank is doing to ensure that we don't have banks that will cause problems. So they're taking 741 billion impairment charge, and guess what? These guys are still minting 1.2 trillion in pre-tax profit. And this is a profit that is not inclusive of FX earnings that we had this time last year, if you remember. So this is pure earnings. In fact, net interest income, if you adjust for expense, is about 2.6 trillion, up 50-something% from what it was the year before. So these are the kind of earnings that you understand. This is what makes you excited about banks. And what is even more interesting to someone like Nancy is the fact that because you know that there's certain banks that will always deliver from a fundamental perspective, especially those of us that are fundamental investors, to then decide to take position. Some of us took position several times last year. When Zenith Bank was trading under 50 naira, when it was trading under 6 naira, the last time you and I spoke was something that I don't know if you took position. I took position. So you can imagine how well to do I am with that. And that's because you see earnings per share, even though it's down, but fundamentally results at 1 trillion, dividends at 8.5 or so naira per share. These are the sort of things that investors want to hear. And it just tells you that with this sort of solid numbers, the sort of leadership they have, future earnings of the bank is likely to continue to grow in the trajectory that it did last year. So my view generally about the bank, and it's not just Zenith, you've seen it as well with GT Bank as well. So you're seeing banks that are churning out solid numbers amidst the economic situation that we have and amidst the regulatory environment that we find ourselves in. And what is even is that core earnings.
Let me now throw up a follow-up question from what you just said, that we are seeing banks throw up these solid numbers despite the challenging environment. So do you think that the performance of the banks, now that we're even looking at Zenith, because Zenith released this result, it was posted on the NGX website, so anyone can even go there and see it. I had to read the report, I think yesterday, in the midst of all the brouhaha I was involved in yesterday, how busy my day was, but I at least ended my day trying to read up on the NGX website, those numbers, seeing what the bank is doing. Now, where am I going to in essence? This performance, do you think is as a result of macro stability or perhaps internal efficiency reforms?
I think it's both. Last year was it was a year where a lot of the macro reforms that we were implementing started to take shape and to creep into the larger economy. I think last year saw a lot of stable exchange rates, we saw a more largely predictable monetary policy environment where you sort of, in a way, knew what the central bank were doing in terms of the direction of monetary policy. It was also easier to understand what kind of fiscal environment that we're in. The only thing that was very difficult to predict was geopolitical issues, which remain uncertain even now. So I think based on that, for a lot of banks that wanted to be efficient, it's easy to know how to play this game, how to position yourself to remain profitable and to find opportunities that can make you continue to compete. And I think that is what you tend to see in their numbers. And I mean, I can take you through some of the efficiency numbers, which is the second point that you mentioned. You've seen customer deposit, which is a very key measure for how well a bank is going, because without customer deposit, then you wonder why the bank exists. So customer deposit up double digits, about 10%, to about 24 or so trillion. You've also seen assets of the bank hit 31 trillion as well. Now, in terms of more efficiency numbers, cost to income ratio is at 45%, slightly higher than it was the year before. But let's also remember that 2024 was an odd year because of FX. But cost to income ratio at 45% for a bank with an asset base of 31.4 trillion is just incredible, because that means you're able to manage cost in a very inflationary environment. And of course, a very competitive environment where you're seeing a lot of banks essentially spend a lot of money just to compete. I think there's of course, you also look at their cost of risk as well, at 6.7%. And of course, one of net interest margin at 10%, and return on average equity at 23.2%. Now, put that into context with what inflation numbers are. So if a bank of size is giving you a return on equity at 20%, where inflation numbers are slightly under 16%, so you're seeing that net shareholders, the bank is giving you returns that is above inflation. So in terms of efficiency, their ability to execute under this macro environment that we're talking about, I think is pretty impressive. And not to make it sound like one is just blowing Zenith Bank's trumpet, you've also seen that in some of the biggest banks that we've seen their numbers out, Italy, for example, as well. They also have this sort of efficiency performance as well. But the difference is that Zenith is much larger. In fact, Zenith's loan to deposit ratio was slightly over 45%, compared to some of the other banks that you're seeing their loan to deposit ratio at less than 30%. So while a lot of banks relied on risk-free securities to earn money or to give us the sort of profitability that we're seeing, any bank appears to have done both. So we've seen them make about $1 trillion or so from treasury bills alone, but you also see them contribute another $3 trillion from other earnings. That's why you see that gross earnings are up. So to me, I think banks that are able to balance this macro story and remain efficient, and seek opportunities within the macro story are the ones that will continue to grow. Now, one last thing to this point, Nancy, also how some of these banks, particularly Zenith, are also growing earnings beyond Nigeria. I think that's one story a lot of people don't seem to be looking at as well, because we're seeing that a lot of these banks are also getting in a lot of earnings from their Pan-African operations and from their outside Africa operations. For example, I was going through the bank numbers, and I saw that the profit before tax from the share of profit before tax from their African operations alone went from about 9% to about 19% or 18.5%. So last year. So what we're seeing is, look, even though you're going through a macro environment where it's challenging within Nigeria, still make money from your core base, which is Nigeria, but at the same time, try as much as possible and expand beyond Africa, where you're also seeing the same macro story replicate itself across countries within Africa, and then see how well it can to make more money and to increase shareholder returns. That's it.
Yeah, what does this really say about Nigerian banks? I don't want to use the word conquer Africa, you know, in terms of our banking sector operations. Because you talked about even the expansion to other African countries. I was looking at the NGX website, you know, taking a look at not just even Zenith earnings alone, some other reports on the NGX website yesterday. For instance, Zenith, I think, is in the Gambia, is in the UK. They are going to open in Cote d'Ivoire, I think, later this month for Zenith Bank. I think it's also acquiring Paramount Bank in Kenya.
Bank
Yes, in Kenya. I think Paramount Bank in Kenya, that MOU will be signed in May. So what does it really say about Nigerian banks, you know, having strong presence in Africa? Not just even about Zenith alone. You know, there are other banks, these big banks, as it were, the Fugas, you know.
Yeah. Another good question. You're so good at asking this question. God.
Thank you.
Yeah, so, I mean, what we've seen is that, and it's not just, like you mentioned, it's not just Senate. We also saw it with UBA last year, 9-month numbers. We've also seen it with GTB. You're seeing an increase in the contribution to their profitability pool from particularly Pan-African banks, you know, to larger, and it makes a lot of sense. Nigerian banks are very well capitalized. Nigerian banks have the skill. Nigerian population, and you're also seeing an increasingly integrated Pan-African environment economy, where intra-African trade is becoming the dominant factor. So it just makes a lot of sense that you have Nigerian banks go out there and compete. A lot of these economies are still growing. And because they are younger economies, they have the potential to grow a lot faster than even Nigeria. And so why don't you want to go into countries that have faster GDP growth rate than Nigeria? Why won't you? Because if you go into these countries that have faster GDP growth rate than Nigeria, then there are a lot more opportunities for you to also be part of their growth story and contribute numbers. For example, Zenith Bank, if it wasn't for their Pan-African operations, their PBT may have even been lower than it was. That's the interesting thing. And mind you, let me give you another example. Ghana, their Ghana franchise, for example, saw their profit go from 15 billion 2024 to over 100 billion in 1 year. That's it. Just 4 years ago, we're celebrating banks doing 100 billion profits. I don't know if you remember.
Yes, I do.
4 years ago, we're celebrating banks. Nigerian banks are now doing 100 billion profit. Now, their Ghana franchise is over 100 billion. The same story for GT Bank. So it's just important for them to go. Now, there's a little bit of caveat. We do know that the central bank is also very, I like what the central bank is saying. You know what? We're not going to allow you expand, continue with your Pan-African expansion if your asset base is going to come down. If your balance sheet, your net asset is not strong enough to absorb the risk of going up. Because they also know that going up means you could incur some losses as you continue to grow, but you cannot do that to the detriment of some of the capital that you're investing. So there's a balance in there. But all in all, I think it is an essential part of any strategy, particularly for the tier 1 banks that have met the 500 billion recapitalization, to have a Pan-African expansion strategy.
Let's take a look at the net interest margin. It came in strong at about 13.7%. How sustainable do you think that this is in a potentially moderating interest rate environment? Interest rate environments that we are in.
You're very correct. In fact, to my surprise, I think a year before it was about 11%. So in to 13.7%, it was higher in 2025. Now, what is usually the differentiating factor is what is the cost of funds to the banks themselves, right? So if cost of funds for 2025 was 4.2%, and so 4.8% in 2024, then it kind of makes sense that the net interest margin will grow. So the cost of funds essentially is saying what exactly is the cost that the bank is incurring for its deposit. So if the cost of funds continues to be lower, and then even if interest rates fall, they are still able to keep that margin that they are running. And that is what part of the efficiency performance that I'm also seeing. And so for the bank, can they replicate this same net interest margin in 2026? I think so. Might not be as aggressive as currently is, especially with interest rates going down. But remember, Nancy, as interest rate starts to go down, then savings deposit also starts to go down as well. So the key thing is, what is the quality of deposit that the bank is able to attract and at what cost to the bank? So for a bank with very solid brand, with a solid deposit base, solid asset base, very strong trust surplus, I think it's just, it will be hard for you to bet against them continuing to lower their cost of funds and deliver net interest margin double digits.
You know, I'm just still looking at their numbers here and trying to interrogate further. Let's take a look at the dividend per share, which doubled to 10 naira per share. Is this sustainable, or do you think that this is a signal of limited reinvestment opportunities?
You know, I have who I mean, we're discussing recently on one of our podcasts, and he always mentions what he calls cash earnings. And the two banks that he tends to always mention is Zenith and GT. And if you look at cash earnings of this bank, cash earnings essentially strips out a lot of the non-cash items that are profitability. You see that these are banks that are capable of generating very strong earnings, cash profits. And so a bank that generates these cash profits, you expect them to be able to deliver this sort of record dividends. I do not doubt you would be able to sustain some dividend levels. All you need to look at is what is their earnings per share. So the dividend per share would always be a factor of their earnings per share. So if they are doing a total dividend of about almost 11 naira, that is still less than 50% of their earnings per share. So all they are doing is that they're giving out 40% or 40% or so of their profits to shareholders as dividend, which makes a lot of sense. But at the same time, Nancy, what you also need to look at as well is, and that's what guides dividend policy for banks. When you want to give out dividend, what you need to communicate to your shareholders at the same time is, if I decide that I want dividend to be less, my dividend per share to be less than the year before, then I must promise you that your return on equity needs to be higher that year.
Yeah.
And I should also promise you that my capital appreciation would also be higher. Because if my return on equity is high, and you can deliver a higher capital appreciation. Because at the end of the day, it all depends on who is able to do more what money. So dividends are paid to shareholders when businesses do that. You know what? Shareholders are better off taking this dividend as well. And these days, retained earnings are not as solid as they used to be because the CBN doesn't really guarantee them, it doesn't really account for them as part of the share capital that they want. So why keep on retained earnings? So what these two banks have demonstrated is that they have the retained earnings that they have is so solid that they can distribute a good chunk of it as cash dividend. And so I don't expect them to go below. In fact, I don't want them to go below that 10 dividend because I'm a shareholder. So it's very important that we get dividend, especially for those of us that are long-term holders.
You know, I always tell my viewers, I've been telling them for years, the stock market is one investment outlet where you can make money. It's not a Ponzi scheme, though, but there's also a style. There's a style and principle to trading in the market. And now the full season's earnings will be coming out from banks and from other companies listed on the exchange. Investors and shareholders would also be smiling to the bank. It's also an avenue for those watching and you have perhaps little money to spare. I'm advising you to invest. So don't put all your eggs in one basket, or don't put your monies in the banks. The banks did not like me at a time. You know, don't put your monies in the banks because they are not really working for you there. There are other investment outlets. But moving ahead, Ugo, we saw that customers' deposits grew strongly. Talking about this earnings, what does it say about confidence in the banking sector? That our people are still leaving their monies in the banks? And with what we've seen from Zenith, do you think that we would also see an improvement post-recapitalization? Now that Nigerians will even have more confidence, you know, to transact, to do businesses with our banks. And even with this, how will it also translate to the real sector? As a shareholder now of Zenith, like you said, can you walk into Zenith now and say, okay, I have a business proposal. How confident will you be that they're going to support? I think that's the cocoa of it all, really.
You're very right, Nancy. I think this is where a lot of banks still fall short. Remember, I talked about loan-to-deposit ratio, and there are some banks that already have loan-to-deposit ratio of less than 30%, which clearly shows that you know, the banks are happy to lend money to the government than to businesses, and you can understand why. This is still out there. The central bank is also very big on risk management framework on this bank. And so no bank wants to mess around with customer deposits. And let's also understand that, I mean, lending money to the government is actually quite lucrative now. The interest rate at high double digits. So, however, I think that with banks now crossing this recapitalization threshold, I think you're going to see a lot more lending to businesses, not just the real sector, but to businesses in general. So I expect to see credit, a private sector credit, as a percentage of money supply to increase this year compared to the year before. For Zenith, no surprises that we've seen, you know, their customer deposits, you know, grow in double digits. We also saw that as well. I think I also saw that in GTD as well. Well, what is remarkable for me is that within all the competition that you're seeing from new banks, it kind of looks like, how can a bank like Zenith, as big as it is and old as it is, because it's been there since 1992,
1990, yes,
still be able to grow its deposits by 11%, right? So we've seen deposits go from 21 trillion naira to about 24 trillion in 1 year. So it's remarkable. ETB as well also grew their deposit in double digits as well. So it tells you that it's either Nigerians are just happy to move their money around all these banks, or Nigerians just also know that, you know what, while we love the efficacy of some of these, you know, smaller new banks and how good their apps
and the fintechs,
when it comes to really securing my money, you still want to deal
with the traditional banks. Yes.
Yes, because that's where you want your money to be. So it kind of looks like that's what we're seeing here. But until we hear from their earnings calls to understand why we're seeing this deposit growth at this sort of aggressive levels, we won't know. We can only but speculate. But to me, as a shareholder, very impressive seeing that you know, this bank deposit is growing at double again. Let's also not forget the angle of their Pan-African expansion. And that is why, like I told you earlier, it's important for these banks to also go beyond Nigeria, because that is where growth is. And so they are also increasing not just their deposit outside Nigeria, they're also increasing their loan book outside Nigeria as well.
Okay. Ugo, just before we go, let's take another issue that just also came out, which is the FTSE Russell reclassifying Nigeria to the frontier markets, to the frontier market status. How significant is this, perhaps, in real capital flow versus sentiment? And do you think it will really do anything, especially to companies listed on the exchange, including the banks that we're talking about? In just a minute.
Oh, this is, I mean, I saw the wire yesterday last night, and it was fantastic news to me. I think back in October, it had put us on a watch list
Yes.
After after yanking us off 2 years because of contract issues. So by including us now on the frontier, from classified to frontier, that opens the window to foreign portfolio participation in the capital market. Nancy, last year, Nigeria attracted $19.7 billion in foreign portfolio inflows. Do you know how much of that went to the equity market? Just $1 billion. Yes, so most of it went to the fixed income market. And that's because the way foreign portfolio investors operate is they tend to wait for countries to be included in, in some of those listings before they invest. So that is what gives your country the exposure for them to invest in. So the fact that we're now in the FTSE Russell Index then means we can now start attract foreign portfolio inflows in foreign investors who rely on this index to determine which country they want to put their money in. We expect a bit more. FTSE is just one of them. MSCI index is also there. We're still not back yet. I think there's a lot of work going on to get on that list. Now, what does this mean for shareholders? Now, the Nigerian stock market story has largely been domestic driven. A lot of all these growth that we're seeing, the 51 or so percent I saw last year is domestic. This year, we've seen 29% year-to-date upside, all domestic, because domestic participation accounts for about 90% of the participation in the entire market. So now that we are seeing the likes of FTSE bring us back into the index, I expect to see a lot more foreign participation into the market because they've all missed out. And so I won't be surprised if the fugas like Zenith and GTP, who are giving out important intelligence, start to see their price to earnings ratio, which has been low single digits for years, start to hit double digits.
Okay.
Mind you, yes, these banks are trading at 4x, 3x, 4x, 5x of their earnings. So by the time I reprice by foreign investors, I'll be surprised if these guys start to trade at 8x, 9x, 10x, and that could mean further upside in the Nigerian capital market. So for those who participate in 200 trillion naira capital market, this is the window to achieving that.
Okay. I think we'll leave it at that. At least we've taken a look at those earnings. We'll continue to also focus on other earnings as they come out, because this will really be an interesting season. And I'm wishing Nigerian companies well in 2026, especially with this crisis that we're seeing, the tensions, and I wonder how that will really play out. We're seeing higher production costs.
That's a story for another day.
Yes.
I'm happy to discuss that.
Yes, operations and co. All right, my friend, thank you. We'll get to speak soon. I'll perhaps see soon. I'll be speaking with Ugo Dre Obichukwu, who is the founder and chief executive officer at Nairametrics. That's the show today. Thank you all for watching. Be the best you can be and be the change that you want to see. I am Nancy Naji. Bye for now.